Hello everyone, Russ here with the Morrison Mortgage team and
Giles
Jordan. We are the Morrison Mortgage team, and as expected today, Wednesday, June 1st, is that we have seen a half-point increase to the Bank of Canada prime rate, or the overnight rate, and then the Bank of Canada prime rate will increase very likely by 50 basis points as well. So we thought we'd give you just a quick update on what's happening and what to expect and just some of our thoughts. So today what we're going to cover is, Giles?
So firstly, the differences between variable rates and fixed. So two types of variable, VRM versus ARM versus FRM, which is fixed. Then we'll talk about the prime rate increase, historic trends. Next, how prime rate increase affects payment. Then a long-term forecast, our thoughts on where things might go next. And finally, what to do now.
Okay, so VRM versus ARM versus FRM. Okay, so what we've got here is a variable rate mortgage, we've got an adjustable rate mortgage, and we've got a fixed rate mortgage. Okay, so we know that in the market, most commonly is variable rate mortgages are ARMs, which is an adjustable rate mortgage. Now, what happens with an ARM is that as the prime rate goes up or goes down, then what will happen is your payments will adjust. Now, as for a VRM, Giles?
So with the VRM, which is the second type of variable, the payments won't change as the rates go up. So what does change is the amortization. So with each payment, the portion that is interest versus principal will change as the rate increases. Now, the common one where a lot of our clients in the variable rate mortgages now, a lender that does this is TD. So if you're in a variable TD rate mortgage, you'll most likely be in you will be in the VRM.
And for those feeling anxious about the rates continuing to rise, that is something that you could push into. You could change your product into a VRM. So if you do have questions on that, you could let us know. The other option today is fixed rate mortgages, which we know that you're secured for a 5-year term at the same rate for 5 years. Right now, the rates are very different, and historically, variables have always been lower than the fixed rates. So, for example, today we're sitting at the adjustable rate, or the ARM and the VRM, being sitting at about 3.3% after the rate increase today. And Giles, how's the fixed looking?
The fixed rates right now are in the mid to high 4s, so still significantly higher than where the variable rates are.
So benefits of taking a variable over a fixed in today's market?
So in today's market where things are, there's still space for the variable. Even if the variable rate increases by kind of multiple increases, you'll still be at a lower rate than where the fixeds are currently. And there's also, with the fixed rate, you are locking into that rate, and there's big penalties if you wanted to get out of it, if the rates might come down as well within that 5-year term as well. So.
Okay, so historically, here are the trends. And as we go back to 1975, go back to the 80s when everything spiked, the brown line is essentially fixed rates, and the blue line is the variable rate. As you can see, there's only been a couple times in history where the variable has been higher than the fixed rate. There's always been a reasonable spread between the fixed and the variable over time. So historically, it has been outperforming the fixed rate, and that we feel strongly, or we like the variable just because for the option that a lot of our clients do make changes during the 5-year term, and the penalties, as Giles noted, are much less for a variable versus a fixed rate, so it provides more flexibility. But some people do have trouble with that, with the changes in payments and that sort of thing. So, okay, so how does this affect our payments? What we have here is that we've done this based on, 3.2% is prime as of yesterday, and then it's now gone up to 3.7. The average discount for a variable right now is around 0.35% on average. So if you had that, your fixed rate would go from your variable rate would go up from 2.85 to 3.35. So how does a half-point increase look at with your payments? Based on a $100,000 mortgage, they would go up by approximately $25 to $26 a month. And as we go to even $500, that's an increase of about $129. And then as we go to $900, that's an increase of about $232. So there is a bit of an increase to come, depending on how big your mortgage is. Once again, if you're in an ARM, your payments will increase. If you're the VRM, your payments will not change. So looking at the long-term forecast. So how much further can they go? The long-term forecast, as noted by the Bank of Canada, fixed rates today and 2 years from now. And what are the opportunities? Giles, how much further can they go?
Yeah, so with the variable rates and all the talk of rising interest rates, the main reason that the rates have been increasing is due to the high inflation right now. So the Bank of Canada raises the interest rates to try and combat inflation. So there are different predictions. Rates may increase if inflation doesn't come down, or if inflation starts coming down and getting to where the target is, they may keep the rate similar. So it is difficult to say. A lot of people are saying perhaps there may be a few more increases on the way. So right now that's a general feeling. However, it is very unpredictable times with everything going on, so it is difficult to say. But we can see historically here as well, with the Bank of Canada rates, they are in a range they have historically been. So this isn't it might seem like they've gone up and they are high, but if we look back kind of over the last 5-6 years or so, the rates have been around the sort of between the 3 and 4% mark before.
Like we looked at pre-pandemic 3.95%, and we're now at 3.7. So it's not unusual. It's just weird because we all are so used to being in a low rate environment. Long-term forecast, as noted by the Bank of Canada, is to expect potentially some more. It really depends on how this increase now at 0.5% or the past 2.5 increases. How do we all respond? And if inflation does come down, there may be more, there may not be more. So fixed rates today and 2 years from now. We all know there's a lot of things going on in today's market. The fixed rates or in our economy, the fixed rates have jumped dramatically in the past 3, 4, or 5 months. And historically, we have not had to deal with a pandemic. Historically, we haven't had such low rates for some time, and we have a war going on in Ukraine. These are all things that affect interest rates over here, which is kind of weird to think that. Of course, it affects our economy so much with all these things that are happening in the world. But those are all things that fixed rates can go up, fixed rates can come down. One article that Giles and I were chatting about this morning was that one article says, okay, well, the rates are going to be 10% in 2 years. Another article says, okay, well, they'll come down. As soon as the war is over in the Ukraine, all the rates will come down. So it's kind of one of those things. Is looking in a crystal ball per se. It's so hard to say but only the future will tell. With any sorts of these things, there's always opportunities that do come out of the woodwork. Some of those opportunities is that some of those people that have been looking for real estate, the prices are starting to soften now. So that's one thing is we do feel that there's going to be more decreases or softening to come. Also, as things soften, we are having more people more of our clients come out of the woodwork to discuss the buying of rental properties and that. So that's something we can certainly give you some advice on. So what to do now, Giles?
Yeah, so there's a few things. I know lots of concerns for people with the rising rates. What are the opportunities in today's environment with rising interest rates? So one big thing, I think a lot of people with costs increasing will be increasing cash flows, having more money in your pocket in case of increased expenses and things like that as well. So one thing you can do with your mortgage is to through a refinance, you can re-amortize, so spread the payments over longer, and so your monthly payment obligation will be less, and that will help improve your cash flow. And then along these lines as well, paying off any high interest debt that you may have. So some people through COVID may have some other debts that have been racking up, and we have had some clients use secondary financing or alternative financing to consolidate that to then improve their cash flow as well. And Russ, you can talk about the final two there.
Equity releases that right now, or property values are they inflated? Are they not? We don't know, but we will see a softening in the months to come. If we do want to access any certain amount of equity for a HELOC, a home equity line of credit, in order to invest or anything like that for the future renovations, that now is the time to consider doing that. And then also rental investment. I do have a couple rental properties myself, and I see there being an opportunity in the months or even the next year to consider looking at something like that. But once again, if anyone has any questions or they need anything, feel free to reach out to the team, and keep well, and we'll go from there. Have a great day.